no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to...
Well, good afternoon or good morning, wherever you are at. This is MrNotAdvice. Thank you for joining me today for this episode of my podcast. Today, I'm going to cover the topic of trading psychology. I've experienced and observed over the last 31 years, both retail and professionals, and might be interested to know that even professionals suffer from some of the psychological and emotional bias and fears when they trade. But before we get started, disclaimer time. I am not an investment advisor, a financial planner, or registered rep. This podcast was made for entertainment purposes only and should not be construed as investment tax or any other advice. Nothing in this podcast is a promotion or sale or an inducement to purchase or invest your money. Never get financial advice from a complete stranger on the internet, and by listening to this podcast, you agree to hold harmless me. Finally, always consult with your advisor before you do anything with your money. All right. So a lot of people ask when they get to trading psychology, I think it's more of a reactive question when somebody knows something's not quite right and it's affecting the way they're trading, be it fears or biases. So over the last, as I said, 31 years, I have had the opportunity to experience multiple different types of markets, both roaring bull markets and crashing bear markets. And what I observed is that the most successful traders are those that can, despite the ongoing outside noise, emotions, hype, they still are able to stick to their trade plan. And I believe that controlling your emotions and thinking about trading and the psychology of that process is actually probably one of the most, if not the most important variables that will lead someone to success or failure. So here are the hard facts. We are hardwired for fight or flight, from which all our decisions come from. Now, this fight or flight severely handicaps our decision-making process because it's a binary decision. There's no in between. New traders lack the large data set of trades to fall back upon. So they refer to what feels best and is the easiest. And that's their own emotion and their own bias because it's something familiar. Most people will do almost anything not to feel anxiety or fear. That goes for not only trading, but in their life. We see people compensate for this through exercise, drinking, drugs. There's so many ways that people cope to not have to experience negative emotions. And I think in trading, it's vitally important to acknowledge that those emotions are there. However, you're going to stick to your plan and trade through it. You're not going to be successful, in my opinion, investing or trading if you do not learn to replace your emotions, your perhaps broken psychological process, your biases. You're not going to be successful if you don't replace those with a process and a procedure. Most people have seen the graphic where it's often depicted as a roller coaster or it's a cycle of investor emotions, right? You go from optimism to excitement to euphoria and then anxiety, down to fear, down to panic, down to hopelessness, then back up to relieved, and then optimism, and then we go in a circle. And I believe that cycle, which the industry has promoted as something that as an investor you need to be aware of, I actually think it's something that you should not even be part of, because being on an emotional cycle is the problem. It's not the emotion itself. It's the fact that you're on a cycle that is affecting your trade decisions that has nothing to do with facts or data. This is a great example, again, how the industry likes to appear as though they're doing something good for you as retail investors or traders, when in fact they're setting you up by encouraging you to be aware of what your emotions are on the cycle and try to move to a different part of the cycle. You have been lied to your entire adult investing life. And much of what you've been taught about trading and investing is wrong. First of all, the big lie to me is 12% per year is good. That 12% per year sucks. I just saw a chart that I shared with my members. JP Morgan was taking a look at average returns in the markets, annual returns, and retail investors have averaged about 3.5% per year. And if you factor in the rate of inflation, that is a pitiful return. Then if you also factor in the length of time in order to achieve that, because remember, the industry loves long-term hold. That's what they promote. Then you're taking an inordinate amount of risk just to achieve 3.5%. And that's the average. So there are a third of people that are below that average and a third above. But my point is 12% a year is not good. It sucks. Also, you've been lied to that holding investments long term is a good idea. It's not. It's a terrible idea because you don't get the returns that you would if you were using the way I trade specifically, where I attempt to catch momentum for short-term trade opportunities. I'm using options. The reason why the industry wants you to hold those investments long-term is because they make money off of it, right? They loan, they borrow. So the industry's motivation to be out there and encourage long-term investing is not for your benefit. It's entirely for their own benefit. Another thing that you've been lied to about is that there's this tremendous amount of information and media overload, and it's intended actually to get your emotions working and in the process of investment decisions, and that will be used against you. For example, FOMC Day. Back in the day, 15 years ago, when FOMC Day occurred, my firm, we didn't even know it was happening. We'd find out the next morning or later in the day. CNBC has become sort of the ESPN of the financial world, along with Bloomberg TV. They soundbite every single data point, but not every single data point is material to investing, quite frankly. Then we have just an absolute explosion of financial websites where you can get good information, and then we have many, many more financial websites where you can't get good information. It's bad information. So I think the big lie is that you can't do it yourself. You can't trade successfully. You can't invest successfully. Only professionals can. And I will tell you that my free members and my VIP members are living proof that that statement is completely wrong. The reason why I think most people fail is they fail to learn how to trade because their goal is wrong and they don't even know that. Here's what I mean. Retail likes the burst of dopamine that comes from the hope and the potential of a trade. And win or lose, they will keep returning to get that hit, right? It's sort of like a person who sits at a slot machine. Yes, they want to win, but what keeps them coming back, loss after loss after loss, is the pulling of that handle, is pushing that slot button and that dopamine rush. It's quick, it's powerful, and your brain can actually get addicted to it. And I think that is the goal of most traders, to get that rush. And I don't think most traders are even aware of it. So, at the end of the day, why should you care about, trading psychology? Trading psychology and control of emotions literally is the single most important factor that will lead to success or failure in trading and in life, quite frankly. How you respond to profits, how you respond to losses and mistakes, that changes as you build new good habits. So you take what you're currently doing, start adding in new habits, right? And over time, those will then replace the bad habits and make you less likely to succumb to trading psychology errors and emotion. Trading is a serious business, and I don't think a lot of people understand that it is serious. It's not a game. It's not a slot machine. And you really need to be serious and objective and analytical about how you go about the entire process. It's not just enough to find a company you like. There are so many other decisions that need to be made that, quite frankly, most retail doesn't make those decisions. Risk to reward, holding time period, price volatility, simple things like that you really need to know if you want to put the probabilities of making money consistently in the market in your favor. Buying what you think will go up or selling what you think will go down is not trading, okay? That's guessing. Managing your risk and sticking to your trade plan, that is trading. My first rule of trading is protect capital, right? It is not to make money. Making money is the outcome of me following my trade plan, which is based on the foundation of protecting capital. So if you want to be a better trader, really taking control of your psychology and emotions is key. Now, what does good trading psychology look like? Well, We're going to replace emotions with new hardwired habits. We'll remove as much emotion as possible from the decision-making process and replace it with boring, repeatable steps. I get this comment from people who have been in the Discord or are VIP paid members, and they'll come back after a couple months and say, this is sort of boring. I mean, it's not exciting. We don't read a lot of news. We don't fall in love with companies. We trade setups and we make money. And yes, it is sort of boring. And that's probably one of the things that if you've been in the market and investing for some time, you're probably going to go through some withdrawal symptoms emotionally and psychologically, because you're not going to need to sit there and devour every single bit of information. It doesn't add alpha. It just complicates the process. Okay. You need to refuse to allow yourself to get on that emotion cycle, that emotional roller coaster that the industry has promoted as a guidepost. You shouldn't even be on it. Your goal is to have non-emotional objectivity with analysis and probability, okay, calculations. That's where you want your intellectual energy to be focused, right? You don't want that to be robbed by your emotions. So the whole goal for good trading and developing good trading psychology is to literally rewire the brain. So a successful trade process will look like this. You establish a thesis. I want to go long. I want to go short. You analyze the probabilities. What's the seasonality? How high do I think the price can go? From a statistical standpoint, can it get there, or how low do I think it can go? Then you construct the trade, whether it's options or stocks. I use options, okay? Execute it and then manage it. That is the framework for every successful trade process. And then you fill in each section with detailed steps. Now, let's go over some of the common biases and bad habits that traders, investors, people also fall into these traps in their real life. The ones I'm going to cover today are gambler's fallacy, having too much or too little confidence, doing too much analysis, having too many indicators, what I call post-preparation overthinking, then a failure to launch, being impatient, YOLO and FOMO, making decisions driven by greed, and then finally, just giving up on a losing trade. So let's look at each of these. Gambler's fallacy comes from the belief that it's actually the belief in the law of small numbers, which means that small samples are representative of larger samples. So that would mean you did a trade in Intel, you made money, you did a trade in Microsoft, you made money, and now you think that you are a tech expert. You think that you will always achieve these types of gains. That is completely unrealistic, but it's something that many, many people fall into. The recent success or failure of a trade, that is not the measuring stick to say, hey, I'm a great trader, or hey, I'm a bad trader. It's not just one trade or even a couple trades. It's a longer term, at least 100 trades, in my opinion, plan that will overcome gambler's fallacy. But our minds, we want to arrive at conclusions and outcomes as quickly as possible, right? We do that because it lessens internal stress and anxiety. We don't like the unknown, and we don't like to wait for the unknown, and we especially don't like to do that when there's money involved. And so you can see why it's easy to fall victim to the gambler's fallacy. This list that I'm going through of biases and bad habits that are common, you may have experienced some of them, one of them, but they never truly fully go away. It is only through discipline and having a solid trade plan that you can, for lack of a better word, you can minimize the effect. These common biases and bad habits, everyone experiences them to some degree. Even I can experience them, although they don't last very long because I have replaced most of them with my trade plan and habits. So the second one I'm going to go over is having too much or too little confidence. Professional or academic experience with investing or trading does not contribute to make a great trader. It's not going to make you a great trader just because you read every book. It's not going to make you a great trader because you have a finance degree. It doesn't mean you're going to be a bad trader, but it's important to realize there are book smarts and then there's the application of that knowledge. Assuming you are wrong or your trade plan is bad because a trade loses money, there are many mistakes in there, right? We got gambler's fallacy. but we also have a lack of confidence. And the confidence that I'm thinking about is not confidence in yourself in this instance. I'm thinking about the confidence in your trade plan. I don't know how many people trade and the confidence they seek to achieve is either in themselves or a complete stranger is telling them to buy or sell stock. Okay. I see also people do the other side where people assume that, well, I'm not smart enough to be a successful trader. That's absolute bullshit. To be a successful trader takes discipline, it takes hard work, okay? But it's not based upon your IQ level. And in fact, I would say, I would venture a guess that in my experience, those people who have almost no knowledge of the markets, no knowledge of trading and how you're supposed to quote unquote trade, do better over the long term in trading. I have students that are classic examples of this. I have a student that didn't even know what an option was. And here we are a year later, and he's trading on his own and he's profitable consistently. So also, if you think about it, what happens when you have false confidence? Well, you take undue risks, right? You size up, you buy too much, you get too aggressive. So having too much or too little confidence is another trait that can severely harm your trading success. Doing too much analysis. This happens quite a bit. So, oftentimes when you're looking for relevant and useful data, you're going to try to review as much data as you can. I want to read all the financial reports, all the news reports, all the analyst reports, every post on Twitter about it. And the problem with that is while you are increasing the data, you are also increasing the number of decisions and calculations that need to be made exponentially. Having a trading methodology that's built upon a massive amount of data, it also provides you with a false sense of security, right? It's that old weight test. Well, I've done so much work. Look at all the notes I've taken. I am going to be successful. That's actually not a precursor, or it doesn't determine success by having more and more information. Your confidence should be placed in the methodology, not in the amount of data and analysis you've done, because there really is a diminishing return that the more you learn beyond a certain point about a trade candidate, the less alpha it will produce and the more false confidence it will produce. Okay? So we truly, as a trader, you want to run away from anything that's going to put you in the position to be tempted to succumb to bias, emotions, or bad trade psychology. Another thing I see are people with charts that have about 20 billion indicators on them. Look, adding indicators makes you feel good, right? They're visual. In hindsight, they look like they work perfectly, but they don't. Remember, I base my trade decisions on price, right? I don't use moving average crossovers or RSI or any of that because those are all derivatives of price. So that, therefore, their predictive capability or predictive power is reduced, less than what if you had followed price. So indicators add a complexity to the trade analysis and decision-making process. They don't add alpha. And as with other bad habits, we seek outside reassurance. This time it's indicators to help overcome anxieties. There is no indicator, line, signal that will make you a successful trader, period. You can spend all the money you want and buy an indicator or whatever it is, or a signal, and you will not make money over the long term. And I've seen this happen. I tried using multiple indicators in the first 5 years of my career, and they all failed. I mentioned a couple of them: moving average crossover, MACD, fast versus slow moving average crossover, RSI at the extremes. You name it, I've tried it. So it's not to say that all indicators are bad, but indicators are a specific tool, and I only use those indicators that I have a verifiable history that they have added alpha to my trade plan. Another thing that I see is post-preparation overthinking. So you've done all the work, right? You started off with protecting capital as your thesis. You've identified a trade candidate. You haven't succumbed to gambler's fallacy. You aren't overconfident or underconfident. You've done everything you can do. Most people won't stop. They'll keep going to find more information, more data. And they're not doing it necessarily for an objective reason. They're doing it to support their own view so that they don't feel anxiety about the investment they just did. There is a difference between preparation time and competition time, right? Sports teams practice, and then on Sundays for football, they play their game. And when they get ready to play their game, they're not thinking about, maybe I should add this extra practice on this technique or this move or this skill. No, they're ready. They know they've prepared during the week, and now it's time to enter the field and compete. Overthinking, this post-preparation overthinking leads to hesitation. Hesitation leads to doubt, and doubt leads to fear, sounding very Yoda-like I am. And finally, more analyzation is not going to lead to a different outcome for the trade. Really think about this. Once you've made the decision that this particular trade is a good opportunity, analyzing it more and more and more is not going to make you feel any more confident. Again, you shouldn't seek the confidence out of the price action or out of your own abilities. You should know that your confidence needs to come from sticking to a trade plan. Impatience, I see this a lot. I experience this. When you decide to get serious about trading / investing, I tell people, write down a simple trade plan. And it consists of what happens if I break any rules? Do I shut it down? What happens if I succumb to fear or I succumb to the gambler's fallacy? Again, I shut it down. You have different steps in a trade plan. But here's where people mess up. They expect immediate success. I created this trade plan. I had it reviewed by MrNotAdvice. Here I am in week 2 and it's not working. So I'm going to go change it. Look, expecting success within the first 90 days, and when I say success, I'm not talking you're going to, winning trades. You'll have some of those probably. I'm talking that you have figured it out. You are fixed. You will never make these mistakes again. Completely unrealistic, and you are setting yourself up for failure. Frustration is normal, as are mistakes. So, you need to cut yourself a break as you learn to become a better trader. And you should measure growth against following your rules, not your profit and loss. And this really blows people's mind. Well, isn't the real measure of whether I'm successful, whether I'm making money? No, actually, making money is expected. Making money are the fruits of your labor, okay? I mean, I envision it like you're planting an apple tree. There will be apples. There's a high probability of it. Now, how do you increase the yield of the apples? That's having a good trading plan. Right? And that's how you measure the success, is how good is your plan and how good are you following your rules. Truly, it takes about a minimum of 100 trades where you follow your rules to really be able to confidently predict whether or not that trade plan and whether you are moving in the right direction to become more like and hopefully like a professional trader. Failure to launch. I see this too. So oftentimes you've done all the work, you are ready to push that trade button and you just can't do it. Right? You just freeze and then you miss the entry. Another thing I see is, I'll have a limit order for my option price. Let's say it's a $1.20. And I see people where it's a $1.15 and a $1.16, then a $1.17. And then they don't want to pay $1.17 because it was a $1.15 3 minutes ago. And that is just, in my mind, an excuse because inside they're not confident. Why not? Well, they're not confident because they're probably starting out new. They don't have that emotional history and psychological history that's helping them rewire their brain. And they might have past trades that they've really lost a lot of money in and they're fearful of doing that again. So, and remember, a failure to launch can happen at any stage in the trade process, not just when opening the trade. I mean, you could have a failure to launch in the middle of the trade, taking profits, scaling, and you could freeze then too. The opposite can also occur other than the failure to launch, which is just literally where you fire away at trades because you're so frustrated and angry. I have experienced this. I lost $30,000 in 15 minutes over 60 trades. So I used to scalp. I don't do it anymore just because I find it completely unenjoyable. I made money doing it. It's just, I don't like sitting in front of a screen all day. But I decided, well, I'm a professional and I'm pretty smart. So, the overnight session for the S&P futures has very light volume and, I think I can move price around. So I broke my first rule, which was I don't trade in the overnight session. So I should have shut it down then. What did I do? I started trading and I had losses, small losses, $400, $500 here. But I started getting afraid and I started doubling down. And then before I knew it, it only took 15 minutes. I was down over $30,000. 60 trades. So I did the exact opposite of failure to launch, which is go out there with a machine gun and the bullets are your money. Giving up on a losing trade. I see this. I have done this. Sometimes you have a trade that goes against you, against your thesis so quickly or badly that you just say, I quit. I'm not going to watch it anymore. Well, you've truncated the process that every trader goes through. There's entry, there's management, and exit. And so to say I quit is not a decision that has been born from objectivity and logic. It's entirely from emotion. If and when you find yourself feeling that, it's good to step away. It's good to review what your trade plan is. It's good to self-speak positive things. As much as I hate doing that, it is effective. But when you give up on a losing trade, it's only going to feed and compound negative emotions. Then you're going to probably start to feel guilt and self-doubt and then maybe anger, maybe revenge. So look, it's normal to feel exasperated sometimes or even defeated. But remember, it is just one trade. People get tied up in every single trade, like this trade's got to work, mostly because they don't have other positions or they've oversized and they're not really managing portfolio as much as they're managing a single stock or investment. So YOLO and FOMO. We know what YOLO and FOMO are, right? You only live once trades where you just say, screw it, I'm going to bet everything. And FOMO is, oh my gosh, everyone else is making money. I want to make money. Everyone experiences them and they happen at different stages of the trade process. I experience them, but I don't act on them. And when I start experiencing them, I literally push my chair back from my desk, take a big breath, and reset myself. You're never going to be fully free of them. Any of these bad habits, perhaps. You can only replace them with a process and a system that will enable you to overcome them, to enable you to control them. YOLO and FOMO are the natural result of comparing oneself to other people. You don't want to miss out, right? You don't want to miss out. Somebody else has excitement, they're making money, and you don't want to miss out. YOLO and FOMO are also both driven by greed. Okay? I want to make money when I invest. I know I will make money when I invest. Therefore, I know not to be greedy. I know not to overposition size. I know to manage my trade. Any number of things that can start you down the greed road. I try very hard not to do. If you experience YOLO and FOMO, I have a perfect solution for you. If you experience that and you're ready to do a trade based on that, turn off your trade, your PC, your laptop, turn it off for a day. Miss the trade. If you do that, there has to be a carrot and a stick in any learning process. There's the stick. You lose the privilege of trading if you find yourself close to succumbing to either one of these. I do that to myself sometimes. If I break a rule, which is rare, I will shut it down for a day. Okay, so those are all the bad things. Well, how the heck do I do the right things? Well, let's take a look at what I call how to be a boss. Number one, before you start the process of trading, you need to clear your mind of all distractions and be aware of what you're feeling. I know it sounds very touchy-feely. I'm from Philadelphia, and this is way uncomfortable. But here's what I mean. If you sit down in the morning and you haven't had your coffee, and your dog pissed all over the carpet, and your kids made you late because they were supposed to be ready to take it, and you're just in a bad mood. Hey, you know what? It's probably not a good idea to be trading. Okay. On the other hand, it's also probably not a good idea to be trading if you just got a bonus at work. You just got a new car. You just had a wonderful date with your spouse. You had a great weekend. Probably not a good idea then either. You don't want to trade when your emotions are ruling. You want to have your logic and objectivity ruling when you trade. We replace emotions with experience and knowledge. Okay? But you have to be realistic. It takes time. It took me time to get to the point where I could do this consistently. And so if you want to be a boss, you've got to be realistic with your expectations. Also, from the list that I provided, identify which ones you're subject to. Perhaps you're subject to anxiety and fear more than any of the other emotions. Perhaps you're subject to false euphoria or FOMO or YOLO. Identify what those are, because then you can preemptively deal with them if you sense they start to develop inside of you. And then finally, I learned this phrase, and I will say it's called leaning into it. So when you feel fear, lean into it, meaning experience it and then objectively deal with it. You are not going to develop the ability to control your emotions just by thinking about controlling your emotions. You're going to have to do something different. So when you feel fear and anxiety, lean into it. So on a trade the other day, we had a big down red day and I had long positions, right? And so, yeah, a little bit of anxiety. What I did is I stepped back. I literally pushed the chair back, looked at it and said, you know what? I have the law of large numbers and probability going in my favor. I don't need to do anything. That was it. That's all I needed to do. Yours might be a little different on how you face fear head on and lean into it. How to be a boss, part 2. The battle is controlling emotions and bias enough to allow new habits to take over. That is the battle that matters, okay? If you can do that, you will rewire your brain. It helps to positive self-speak and use mantras. I know, again, touchy-feely. What do I mean by positive self-speak? Here's what I mean. You can do this. You can follow the plan. You can let the probabilities work out. They will work out in your favor. Be patient. So these are positives, okay? Instead of sitting down saying, I hope I make money. I hope I don't lose money. I hope this goes up tomorrow. None of those are based in logic or analysis. They're all hope, which is emotionally driven. Mantras, what do I say to myself? It's only one trade. I say that all the time. It's only one trade. It's only one trade. It's only one trade. Because when you start looking at things as just one out of a large collection, a large sample, that one success or failure will not impact you emotionally as much. Stop taking trading personally. I see this a lot where I lost money. The market makers hate me and the shorts hate me. They don't care. I'm sorry. They don't know you exist. They don't know I exist. So stop taking it personally. There's nothing personal about trading successfully, right? Like I said, it's boring. It's repetitive. Track those emotions that you're prone to give into. And when you start to feel that emotion, you just close your eyes, take a deep breath, and repeat this mantra. I'm a professional trader, and I'm not guided by emotions. I know, sounds really, really corny, but I promise you, if you say that 5 times, every time you start feeling like you're giving into emotions, it's at the very least going to provide a speed bump for you, where it gives you a couple minutes to think. So I am a professional trader, and I am not guided by emotions. Yeah, absolutely. And as a side note, why I believe in positive self-speak. Look, you go throughout your days, and all you hear is crap about you, about the world you live in. You're not rich enough. You're not tall enough. You're not thin enough. You're not smart enough. You're not good looking enough. But whatever it is, that's all you hear all day long. So I want not only for you to learn how to become a good trader, but my hope is that process would help invigorate and start changing how you look at the rest of your life too. How to be a boss, part 3. Remember this: good little decisions lead to more good decisions, which leads to a positive trend. What do I mean by that? Good little decisions, okay? When you go into a trade, know your stop, know your target, know your time frame, right? Good decisions. Those are going to lead to better decisions. If you know your stop, you know when to get out, and you know how to minimize your loss if it goes against you. If you know your target, you know at what price does it become then a lower probability that price will move beyond that. Probably cause you to scale or take profits. See, it leads to good decisions. Then the trend develops where you're doing this trade after trade after trade. And that's how you build a long-term, sustainable ability to trade successfully. Bad decisions based on emotions are going to lead to creating a methodology that's based or fueled by emotions. And so there shouldn't be any room in your vocabulary for, I feel this. I feel like this stock will go up. I feel like this stock is a piece of crap and will go nowhere. None of that is relevant, and it's emotionally based. So I will tell you that whether you start a pattern or you start a sequence of good decisions or bad decisions, they're going to cascade, meaning they will build on each other. Be aware if you find yourself allowing yourself to go down that bad psychology, bad emotion leading to bad decision path, because it will get worse if you don't stop trading at that moment. One of the rules that I tell people is, look, if you try to trade with FOMO or YOLO, shut it down for one day. Turn off your computer, walk away, and you have to go through the agony of missing all the excitement. And in fact, that should be a good sort of warning signal that the excitement part, yes, you're going to get excited when you make money, but the level of excitement that I see is oftentimes just completely unhinged. We need to, or I want you to learn how to replace those emotions, replace that psychology with better habits. It truly takes 1 year, I believe a minimum of 1 year, for a person to accumulate sufficient baseline data and experience not to blow themselves up. So many people only focus on what they can make, but one of the absolute key principles of trading is making sure that your losses are minimized. How to be a boss part 4. Do not trade alone. I'm absolutely serious about this. When you trade alone, the only person you have to bounce ideas off is yourself. The only person to keep you accountable is yourself. And that's a bad idea because we tend to agree with ourselves or we tend to be too hard on ourselves. So we're at the extremes. Having accountability helps minimize bad decisions based on emotions. So join a community, right? It doesn't mean you have to be there 24/7, but a place where you can share ideas and what you're thinking about doing. And there are people there that can say, well, why are you doing that? I don't think that's a great idea, or is that a high probability? Don't trade if you're already emotionally stressed, okay? There's always other trades. There's always other days to trade. Remember, when you trade, it's a serious business. You need to be sure you're in the right mindset. Okay. You need to be sure you don't have distractions and that you're not tired. Obviously, do not trade if you're tired or overconfident. Here's a big one. Do not watch your profit and loss statement while you're in trades. Don't watch as it goes up and down, up and down, up and down. No, that's going to absolutely spark emotion. Okay. So I look at price at the end of the day. And from a profit and loss standpoint, I don't look at it probably more than, I don't know, twice a week, maybe. Because I know that I'm going to make money. So it's an expectation. And I just look at it to confirm. Be patient with yourself because remember, mistakes that you make, that's how you improve. That's how you learn. Okay. And if you set your foundation as protecting capital and everything else is then supportive of that philosophy, so you're not going to take on too much risk, you're not going to overtrade and all of that, right? But when you make a mistake, you can identify where you need to practice or learn more. So be patient with yourself. Look, trading psychology, really the battle in trading and the competition in trading is truly with yourself. No other market participant cares about you. I'm sorry. They don't. They do not care. So the battle is against yourself, your own perceptions, and bad habits. When you start and you say, well, I'm going to get serious about this, I want to learn, it might feel frustrating. But remember, you've had a lifetime of making decisions in a different way than what successful trading requires. So you've got to stick with it. But you also have to be realistic at where you are on that path to learning how to be a successful trader. Be patient and understanding with yourself, but be absolutely relentless in your pursuit of following your methodology. If you persevere, you will convince yourself that emotions are the surest path to failure. And before you know it, your emotions truly will be in check. To close, I'd like to use an analogy from baseball. When a batter, first of all, the best hitters have a 300% average, which means they hit the ball 3 out of 10 times. They get a hit, okay? Not that they hit the ball, they get a hit. So that means 7 out of 10, they are, if you would want to put it that way, failing. But one thing that the best hitters do is they wait for their pitches. Some like curveballs. Some batters like fastballs. Some blowing away. The best batters will not swing at every pitch. They won't swing at pitches that are close to their pitches. They will wait for their pitch. They ignore all other pitches that are not theirs. And in doing so, they are removing emotion, they are creating good habits, and they are putting probability of success in their favor. If a batter gets up to play and swings at everything, they're going to fail. If you get into investing and you've done no preparation and no knowledge and you take every single trade, you're going to fail. So much about being a successful trader is about self-control, management of information. The best batters only connect and hit the ball, get a hit 3 out of 10 times. It puts into perspective when you're trading, when you have losses. My win rate is about 57%. And yet I'm generating, over 200% return in 16 months. How do you do that? Sticking to the plan. Sticking to the plan. Not succumbing to any of the temptations of bad psychology or bad habits or bias. And finally, it is normal to feel exasperated. It is normal to feel defeated for a moment. But remember, it's just one trade. Okay? Rome wasn't built in a day, and you're not going to learn how to be a better trader in one day. Now, if you come to my Discord community, you're probably going to learn how to be a better trader, or you're going to learn something in the first day that's going to help you become a better trader. But if you really are serious about it, and I don't know why anybody would not be, I think the best place to start is identifying what are the mistakes and the emotions and the thought process that have led to losses and more bad decisions in the past, and then focus on not allowing yourself to succumb to them again. I am of the belief that there is no person out there that I cannot teach how to trade. I really do believe this. I've got, 40 VIPs now. I've only been doing it for over a year. And many of them came from really either bad trading history or no trading history. And now they trade profitably on their own and with their own trade plan that I help create with them. So stick with it. I want everyone to become successful trading because I think the industries are just a bunch of scumbags. So I want you to be empowered to control your own money. And I will close with this. I cannot tell you how many people come to me and say, wow, I learned how to trade. I'm learning how to trade, but these habits I'm learning in learning to trade, I'm using them in my real life too. And it's making my real life better also. I'm not saying that's going to happen to you. This is not a cure-all, but you can't just change one part of your life and not have it affect all parts. I hope you found this useful or at least somewhat interesting. I plan on doing another podcast next week where I'm going to talk about why I think there's a great possibility or a large possibility to see a 50% drawdown in the market. But again, thank you for taking time out of your day. Feel free to check out my website, www.MrNotAdvice.com. I'm also on Spotify and iHeart and Amazon podcasts, and I have YouTube lesson videos also. And then, of course, there's the Discord. If you have any interest in any of these and would like more information, you may email me at podcast@MrNotAdvice.com. That's MrNotAdvice.com. Thank you very much and have a great day.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging on to the